Hi, this is Karen Lin. This is the second part of week two's video. In the first part, we talked about the T accounts and the rules of using debit and credits. Now let's try to use T account by ourselves using the rules that we have talked about in video 2.1. Um, so we talked about how to use T account using a series of transactions that I'm going to list in the future in the later slides. So um, we have some transactions from the Guitar Lessons Corp, which we have been used in chapter 1. And when you look at those transactions, please pay attention to two questions. One, how does that affect the company's total resources and sources of resources? Two, how would you keep recording those transactions using the T accounts? Here is the guitar lessons before our transaction of next month happens. So in the first chapter, we use guitar lessons, their transactions in August, and this is the ending results of the guitar lessons when it has some cash resulted from their first month of operation. For example, cash balances at the end of August 31st is 8,250. Okay, so on and so forth for different accounts in this table. In September, the firm keeps performing its duty, so there are some things happen to our firm. Okay, we call those things that happen to our firm professional language transactions. For example, on September the 2nd, the client served in August pays the company the $600 she owes. That is, in August, we serve a client and we earned 600 in revenue, right? We got the service fee from the client, but the client didn't pay for it. So now in September, we receive the client's payment for the money that she owes. This one particular information is called one transaction because this sort of the thing happen to our firm will change our firm's resources and sources of resources, or would change our firm's assets, liabilities, stockholders' equity, and so on. Okay, you can read. There are a couple of different transactions here. I'm going to demonstrate how we are going to use the T account to record transaction 1 and 2. Transaction 2 is that on September the 6th, the company buys some supplies and not paying for it. It agrees to pay for the supplier later in September or October. So altogether, there are 7 transactions that we are going to talk about, but I'll only first 2. I'll let you read the books and the notes for the rest of them. Look at transaction 1. On September the 2nd, the client served in August pays the company $600 she owes. What happened in August? And in August, if we go back, because this transaction related to the August transaction that the company served a client, but the client still owes the company money, right? So let's look at what happened in August. If you remember in August the 20th, if you go back to the last week's material, you will see that on August the 20th, the manager coaches a client who agrees to pay $1,400 later in August or September. So if you look at what we have done for that client, is that we see that accounts receivable increases and retained earnings increases. What does that mean? That means when we coach another client, it's a management generated resources that increases the sources of management generated resources and kept in the firm, right? And also it increases our total resources, which specifically it's accounts receivable, because that's the amount of money we are going to receive in the future and give us the benefit in the future. That is our asset definition. So again, what happened in August is that we serve someone that increases our management generated resources, also increases the total resources, which is the asset for our firm in the future. In September, that particular client we just talked about pay back $600 she owes. Now, this may not be the full amount that she owes the company. She may pay the company back in different installments, right? So it could be different amounts that they are paying for different times. So she pays back $600 out of the $1,400 she owes. When that happens, we know that we have cash increases, right? So you go back to analyze the transaction. We first go back to our equation and look at what kind of things increase or decreases. Now we look at here, when someone pays the company money, the company obtains cash, so cash increases. In the same time, the amount of money that person owes from last period, which is August, would be decreasing for $600, which means if you think about in reality, if someone owes you $1,400 and pays you back $600, how much does that person still owes you, right? He still owes or she still owes you 1,400 minus 600, that's $800. It's the same idea. So we know that this particular accounts receivable, will be decreasing for $600. Okay. So again, if we think about this transaction increases our total resources, which is cash, also decreases another form of the resources, which is accounts receivable. If you stop here for a while, you check whether your equation is still equal. Now it shows that it is still equal because you are increasing one resource, decreasing another resources, and they are of the same amount, so they basically cancel out. Your equation still be maintained as equal. So how does that link to our T accounts, right? If you look at the T accounts, showing that from August, remember the first yellow table I showed you? From August, the company has accumulated $8,250 cash, right? So our T account first, under the cash title, would reflect that at the beginning of September, which is the end of August, we have $8,250 cash. Now, in the first transaction we just talked about in the previous slides, it increases cash for $600, right? So going back to the rules of debit and credit, cash is an asset account. An asset account increase with a debit, right? So now we are mapping this back to the cash account. When the transaction affect the cash balances for $600, we increase cash by debiting cash $600. This would make our ending balance of cash after this transaction becoming 8,850. We use 8,250 plus 600, that is 8,850. Similarly, accounts receivable, the past month, we have ending accounts receivable of $600, which means some of the clients already pay back the money they owed. Last period, we only have $600 remaining accounts receivable. Here, you will see the remaining accounts payable are being paid back. Okay, so to avoid confusion, the example I just showed you for what happened in August is just one sample from last month. That person has already been paying $800 she owes last month in August 25th. So the remaining balance that she owes was $600 as shown in the balance sheet. So at the beginning of September, accounts receivable has $600 of balance on the debit side, which is being paying back by that particular client in September the 2nd. Now, let's stop here for a little bit and recap what we have done so far. When we look at a transaction, right, we first ask ourselves, how does that affect our accounting equation in terms of assets, liabilities, and stockholders' equity. If you're not familiar with it enough, you can go back to total resources, borrowed resources, owners invested resources, and management generated resources, and look at how that particular transaction affect our accounting equation. Write that down and ask yourself, is my accounting equation equal? Yes. And then I would look at what are the accounts that are affected because of this transaction. We know cash account, accounts receivable accounts, right? And then we go to our T accounts. We look for the particular accounts that are related to what we have just written down in our equation case. So in this case, cash receivables are affected. And then next, we ask ourselves, did our cash increase? Yes. Okay, then I know if I go back to the equation, when my cash increases, cash is an asset account, it would increase with a debit. So then I would debit cash for the amount that the client pays back. And then we would look at the accounts receivable because they pay us back, so accounts receivable would decrease. Accounts receivable is an asset account. Asset account decreases with credit, so we would credit $600. And then we stop and ask ourselves, do we have a debit and a credit? Yes. Are they of the same amount? Yes. Then this is a complete cycle of one transaction. You have to ask yourself in the sense of the equation way, and then go back to the T accounts, ask ourselves what are the types of these accounts? Are they increased with debit or increased with credit? So then you go back to the table or the equation I show you and find out whether they increase or decrease with debit or credit. And then you write down the numbers and check the numbers again. Okay, let's do one more transaction. The second transaction, on September the 6th, the company buys supplies and agreeing to pay in the future. Now, when we buy supplies, we know that supplies increase, right? Supplies is among the total resources, which is the asset. So our supplies would increase. We increase total resources. We agreed to pay for the suppliers, which means we borrowed money from the suppliers. So our sources of borrowed resources, which is the liabilities, will also be increased. They should both be increasing to keep our equation equal, increase in the amount of 550. So you will see an increase on the left-hand side of the equation, increase on the right-hand side of the equation. That keeps our equation equal. Now again, going to the T accounts, we look at a set of T accounts we have. We go for the supplies and accounts payable as we just wrote down. So think about accounts, supplies. Supplies is an asset account. Asset account increase with a debit. So we would debit supplies 550. Now we need to have a credit, right? When we have a debit, we need to have a credit. So we look at the other side of that transaction. The transaction also increases the liabilities, which is more specifically accounts payable. So we will be also increasing accounts payable for 550. If you check the table or the equation I just gave you, you will find that liability increases with a credit. So I'm going to increase my accounts payable on the credit side for the same amount as I increase my supplies. Okay. Finally, how am I going to calculate the ending balance of any T account? This is how. You are going to add up all the things that happen on the left-hand side, and then all the things that happen on the right-hand side, and take a difference between the two. That is your balance. Now, if I look at my left-hand side, obviously my left-hand side is bigger than my right-hand side added up. Then the balance would be sitting on the left-hand side, which means the balance is the difference between all the left-hand side adding up minus all the right-hand side adding up and sitting on the side whichever is bigger.